What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is August 26th of 2019. Well, folks, I hope you all are having a fantastic day wherever you are. And in today's video, we've got a wide range of topics to discuss. We'll not only be taking a look over cryptocurrency markets, as well as diving into why it's better to focus in on the long term than the short term. And then outside of that as well, we'll be diving into equity markets and taking a look at two different perspectives, one that's bearish and one that's bullish, talking about the future output of equities going into the next few months and into 2020. I want to try to give you guys a non-biased view and different perspectives from different individuals in the financial sector. Outside of that, though, guys, we've got a quick message from our sponsor, but we'll dive right into it right after this message. Alrighty, everyone, so let's go ahead and take a quick look over cryptocurrency markets. As we can see here, most cryptocurrencies are in neutral territory at the moment, with most pointing in the red, and this is following the fact that Bitcoin's only up about 1.8% at the moment. We do have a few isolated players that are doing really good. Chain picking up steam right now, Synthetics Network, Quant, a few others, but again, not on any like serious volume to where I'm getting really excited for some of these players. Again, and you have to always discount a lot of the volume depending on what exchanges are backing that volume for that cryptocurrency. So again, nothing too exciting going on in the altcoin space. Bitcoin relatively flat right now. We had a pretty big leap up in price here, a few $100s. However, we're going to take a look at why that happened in just a few moments, and why as well it teaches us again to focus on the long term, not trying to make short-term risky bets on cryptocurrency markets. As we can see here, again, market cap has been increasing over the last week. We've got a $10 billion gain here. Again, setting higher lows here and starting to set up the curvature to start moving higher, hopefully, as we see Bitcoin approaching the wedge. Now, as we go down here to Bitcoin dominance, again, keep an eye out here for a potential break on 70%. If we get up to 70% and see a sharp rejection around 1.52%, something like that, again, that's where we can start to see a shift in the trend, altcoin dominance picking up. And I gotta say, the one thing that's got me a little bit hopeful for this, and again, I think we already know that the wedge here is building for Bitcoin. This is obviously something that's significant. It's support on the 100-day and the coiling between the 50 and the 21-day to the 100-day here. You can see the blue and green line and the orange line. This really has me excited. And again, so long as we can hold above here and close at and again, the range where we really need to close above is actually getting shorter and shorter. We just need to get something like 11,500. Again, 12,000 would be a really solid confirmation. Even though all of this is really exciting to me, and I've probably rambled on too much about this one specific thing, I want to go ahead and focus in on taking a look at some of the other cryptocurrencies out there. I want to go ahead and spend some time to take a look over some leading altcoins from Ethereum to Litecoin. And the reason is that both of them are showing very similar patterns in the sense of their price. We'll also take a look at XRP as well and give a little bit of perspective to both sides. But I want to go ahead here. We'll talk about the bullish case scenario, and really we can find that in Ethereum and Litecoin. So first off here on CryptoWatch, I'm going to go ahead, get the right exchange here that I want to look at. Coinbase Pro should have a good amount of price action here for Ethereum. We can see here I've got a really simple technical pattern here, and that is a descending wedge, one where there are lowering highs and lowering lows. However, the lowering highs are coming in at a faster rate than the lows here. So again, if you look at this on the surface, some might say, Nick, a descending wedge, that sounds bearish in nature, but it's actually a bullish indicator, especially after having a breakout from the lows here from $80 to $360, right? I mean, it's a big increase in price there. And again, this is something that usually follows. And you have a pullback towards the moving averages. I would have loved to see this hold on the 200-day moving average, but more than anything, the sign here is that it's not only a bullish indicator in the sense of TA, and if you guys haven't really studied technical analysis and you want to, you guys are welcome to watch my free TA series on my channel. But along with that, the thing is, I see a lot more pressing towards the upside here of the line of resistance than I do down here, and that makes me really excited. That shows that the pattern itself is usually going to fulfill itself. If you see a lot of upward pressure towards the upside, again, as we continue to formulate these lines and there's more pressure on that side, then that usually means that a breakout is looking to come in time. But again, there's no guarantee. I'm just letting you all know that's what I'm reading from the chart here if I was to look at it. And quite frankly, I like seeing Ethereum at $190 versus the $364 I was seeing it at a few weeks ago. Again, bringing back a lot of the price action here, finding support as well. Take a look at where we found support here, right on top of resistance here before we continue a lot of the breakout. Now again, going back to the assets here, let's go ahead and take a little bit of a look at Litecoin. Now we got a lot of Litecoin fans out there, and I'm going to go ahead and, seeing as, actually we could do Coinbase Pro here. We should have enough price action. So again, same principles here. Drawing the line of resistance, right? These are really kind of the key points of resistance here. Some people might draw it a little bit different, maybe a little bit lower. And then along with that as well, we want to go ahead, and I'm actually going to draw it from this direction because that's the only way we really get a smooth line between this support level and this support range as well. And again, a lowering range of highs, or excuse me, lows in this case, that are going at a slower rate and decline than the highs here. Now again, you can adjust this a little bit more. Some of you might get more of like a descending channel if you were to take these lows, but it's not going to line up as fairly with the candles here that you would get over from this range, right? So again, we're seeing this range where prices are not declining that fast when they are setting new lows in the altcoin space. Not to mention as well, there's not a radical amount of sell volume comparative to the buy side volume that we had. And again, this is common to find when you've gone from, $22 per coin up to 146. It makes sense, right, to have these kind of pullbacks. I like seeing, in fact, as well, that we're actually at half of what the price was at the high, this 50% correction, because in this case, you have $70, double that, 140, plus $3, and then you get up to 146 in total. So really nice to see below the 200-day moving average on the support range before the breakdown. Again, another thing that I think a lot of people aren't noting, $70 right here. Again, previous resistance in the past. So you want to see, again, this support building over time. And I like seeing, again, 50% corrections, these kind of cool down periods. Altcoins have mitigated a lot of their gains in this case, providing us an opportunity to possibly take some risk here, right? But again, you have to determine that for yourself, guys. Now, when we talk about risk, I do not want you guys focusing on the short term of things, okay? I can't tell you what to do. You are going to go out there and do what you want. It's a free world in the world of cryptocurrencies, and I'm so happy you get to have that choice to do whatever you want. But I'm going to let you guys know, I personally do not. First off, I don't trade on any margin trading exchanges because the few that I think were available in the United States have shut down, and I don't use a VPN. I would not advise you guys to do anything like that. And quite frankly, again, you guys can do what you want in the sense of margin trading. If that's in your risk appetite, fine. But I want to let you all know that there is a huge set of flaws that come with margin trading. Not only not knowing how to margin trade, which I'd say 95% of people don't know how to use margin effectively. And second of all, a big part of that as well comes with a lack of risk management that I see with a lot of people who really don't know how to trade properly. They jump to, trying to read charts and stuff. They don't know how to mitigate risk in their trades and work with the trading strategy. That would play into that whole kind of 95% of why people lose. But even for those who really do everything by the books and do everything proper, a lot of people end up losing big on margin trading. Why is it? Well, guys, quite frankly, I've talked about it for a very long time on the channel. Margin trading does play a big role in pushing the short-term swings of price, but they're very unpredictable. And along with that as well, as the term comes, many people get wrecked from it. Now, there's a lot of reasons for this. Again, some people overexpose themselves. They go off of too much margin when they're trading or too much leverage, right? Trading something outside of maybe 3 or 5x for a short-term trade, something like, 20, 50x, because people think, well, if I just get 1%, then I can make 50% on top of my original position. And if I get 2%, I could double my money, right? That sounds great on paper, but you also share the same risk on the other side. And again, there are very select few players, keep in mind, whales, who are playing against one another, doing this right now on margin trading exchanges. And it's really a matter of who plays their cards right. Not to mention, I want to make it very clear that the trading engine of companies like BitMEX, so many crypto exchanges actually use the same engine that BitMEX uses. I just know this because I've studied the back-end systems for exchanges. They're outdated systems. They're built decades ago. And again, they probably renew them over time and upgrade them. But there's a lot of issues that people have when they don't get orders fulfilled on BitMEX, things of that sort. So guys, personally, just for me, I stay away from it. I don't have a BitMEX account. I never will have a BitMEX account. And quite frankly, I really don't think this is in the risk appetite for most retail investors. Again, it's systems like these that just suck money dry out of the retail investor. And more than anything, guys, it's not a matter of, just, taking as much risk as you can to multiply your Bitcoin. Look at what I'm doing. I'm averaging into the market. I'm building my long-term investment portfolio, and I'm preparing for this next cycle, which I think we all agree, if you guys are here for the bullish long-term vision, that you see this market multiplying multiple times over the next few years. And why toss up that opportunity to hopefully have 10 to 20, maybe 30, 40% more Bitcoin? If you lay your cards right, putting it all on the table, I don't have that kind of risk appetite. And I don't think you guys do either. But you'll have to determine that for yourself. Again, I want to reassure that, guys. You can look into it all you want. I personally wouldn't recommend it. Okay, so let's go ahead and take a look at traditional markets. So futures are up about 0.5% at the moment. And the reason for this is supposedly after last Friday, where we had a 3% sell-off in the market, and have already been in really kind of scary territory in the sense of how the market has been topping. The formation looks all too clear that stocks are ready for a pretty clear pullback. That all being said, there's been recent comments from President Trump in the state of more trade talks coming soon, and resolution to what happened on Friday, where we were just talking, bear in mind, about China hinting towards new tariffs, the United States coming back in retaliation with more tariffs, and along with that, the United States possibly using certain mechanisms to force companies back to the United States. Okay? It's a crazy whirlwind event, guys. There's no way to describe it. I would say this. I want to kind of ramble on this a little bit, and then we'll take a look at the overall market, take a look through those, again, the positive and negative perspective of the current market at the moment. But I want to go ahead and summarize this in the short term. Short term, guys, I think this pop-up in the futures is going to fade by the end of the day. Reason being, I don't think anything's progressed over the weekend. I don't think there's any serious trade talks coming, with China literally saying we're willing to take the beef and, raise tariffs on our end as a countermeasure, not to mention, when the U.S. is hinting towards boosting more tariffs, and then also talking about, we'll use mechanisms to bring companies back. This just seems like it's getting heightened, and this is algos probably trading the market in this case. Algos will pop off of news of tweets or things of that sort, or simple headlines, and they buy up the market if the risk profile is there. This doesn't look very good to me. Again, this looks like it was pushing towards the previous lows here on the 15th of August, and is very close to where we were back on the 6th of August as we started to turn over in the market here. Again, weekly pattern looks all too clear here. We're at the top of the market, guys. So, again, and there might be a room for it in the long term to move up higher, but in the short term, this looks like it's too much risk. Now, in the long term here, in the talk of the trade war, honestly, I really am interested to see how this is going to turn out, because as much as it might seem kind of, monotonous to just keep raising tariffs, and that this is inevitably going to hurt a lot of individuals on the global scale, I think this is really one of the only leveraging tools we have in the United States. And it's not just going to bring China to the table, it's going to bring a lot of countries to the table, because I think most of us agree who understand economics, tariffs are not good for the economy, right? They are pretty detrimental because they do cut down on free trade, they cut down on growth and exports. That being realized, this is going to bring a lot of countries to the table because it does affect everyone. And it's going to apply geopolitical pressure from all different fronts for China to come to the table and talk, right? Again, if it's not beneficial for any of us, it's kind of like for example, mutually assured destruction of nuclear weapons in this case. It's like, look, if we don't come to the table and reach a negotiation, then we get to the point where we have to really fire these things off, then it's going to be detrimental for all of us, because once one goes off, all of us are going to die because everyone's going to fire their nuclear missiles, right? It's that same kind of mentality of like, look, this is serious. We need to come to the table. We need to talk about it. Now, in the sense of why we're doing this on a fundamental level, I 100% agree that we need to do something to counter this, because quite frankly, in China, where China has been benefiting from a huge trade deficit with the United States, we have also as well, to be fair, there's been a lot bigger issues that I think this is really about, and it has to do with IP violation. A lot of Chinese startups and tech companies have for years gotten away with IP violations in the United States, and it's been a direct hit to the US because the United States, back a few decades ago, chose to focus in tech. We made it very clear that our focus back in the 90s and growing forward was going to be in technology companies. And to see the intellectual property that just getting sucked up and taken away by separate countries across the world, it completely dismantles a lot of the revenue that we should expect to bring into our economy in this case that could help reduce that trade deficit. So I think that's what this is really about. I don't think we're going to reduce the deficit, quite frankly. It's just the world we live in, sadly. But I do believe what it's going to do is possibly maybe reduce it a little bit in the sense of more agriculture exports, saying more dependency on the United States, and along with that as well, reduction of IP violations. So that's what this is really all about, in my opinion. But I'd like to know what you guys think it's about, or if you believe at all that it's important to even consider into trading or investing in this case. Do you believe that this is going to escalate? Do you think it's going to start de-escalating soon? I'd like to know what you think. But boy, I got to tell you, if I take a look at the stock indices, I think we looked at this last Friday, does not look pretty. S&P 500 as well rolling over here, almost setting towards new lows for the month here that we haven't seen since back in June. Dow Jones Industrial Average, same exact pattern here. Again, after setting new highs in the market, we got a pretty significant sell-off here, down a few thousand points. Taking a look at the VIX, which we haven't taken a look at in a while, we are above this yellow line that I had written about in my newsletter. And again, higher basis here every year, right? Back here in 2017, 2018, 2019, we're starting to really pick up here, and it looks like we're breaking out of this yellow line of resistance, looking like we're going to be picking up towards the upside here in the next few months. If, again, no resolution comes in this trade deal that's solidified, I think people aren't going to take these kind of, trade talks as anything serious. Now, I want to go ahead and run through real quick these articles. We've got 3 Bloomberg articles. This is a general kind of summary here, talking again about the futures spiking up here off the news. But the real 2 articles that I want to talk about are this article. So get this, guys. Bloomberg literally comes out with 2 articles this morning. The world's largest wealth manager just turned bearish on stocks. And then the other one is fund manager who beats 98% of peers says stay calm and buy stocks. But anyways, let's go ahead and read through both of these. And let's get a quick summary. Now, thankfully, thanks to outline.com, we can get these articles here, and we can actually read through the full thing. So let's go ahead and read through some of this. So the UBS Global Wealth Management, which oversees more than $2.48 trillion in invested assets, has gone underweight on equities for the first time since the Eurozone crisis back during the mid part of 2010, 2015. So we started to have a lot of tension in a lot of the economies post-2008, post-2009. And we started to see in 2011, 2012, a lot of European countries from Greece. A lot of the PIGS acronym is what it's generally used for. Greece was kind of the poster child of it. But the PIGS acronym, Portugal, Italy, Ireland, Greece, and Spain. Those were really kind of the 5 candidates that people were looking at as a potential domino in the European economy. So in this case, we are seeing that for the first time, they have gone negative on equities. The Swiss asset manager cut its stock positioning relative to high-grade bonds to reduce its exposure to trade wars and political uncertainty, Global Chief Investment Officer Mark Halfel wrote in a note to investors. Risks to the global economy and markets have increased following a renewed escalation in U.S.-China trade tensions, said Halfel, who had so far resisted turning bearish on stocks since the world's 2 biggest economies began their trade feud last year. So, as these tariffs have started to pick up, this is really what's keeping the money manager, who is again heading up this fund management at UBS, startled. He's worried about the trade concerns and how this might escalate because it is something that picks up. I think people have kind of, not taken the perspective into account that literally about a year or 2 ago, $25 billion of tariffs was a big thing, right? Tariffs on $25 billion of goods. And now we're easily adding on, we'll just hop in $200 billion in extra tariffs. And if you think about those in the supply chain system who need to prepare these things, they're sitting there going, oh my God, what? Okay, so there's a 10% tariff on the goods that I'm going to be shipping out of my factory in China. Okay, no, there's no tariffs anymore. We've pulled back those until next month. Okay, no, they're actually back and they're twice as large. So it's like, it's this game of cat and mouse that China and the US are playing now. And it really disrupts everyone in this case. It disrupts the whole supply chain system. And it's as if we are ignoring the fact that the global shipment industry right now is already going downward right now. We're already seeing a slowdown in global shipments. We really have not seen a serious rebound since 2008. But if you look at all the freight indexes out there, is not looking very pretty. There's not much of a demand for the kind of global shipping and freight companies like there used to be back before 2008. Now, let's go ahead and take a look into the positive perspective here, because I'll be fair, guys, we focus a lot on the bearish tone. I'm much more positive on the idea that there is going to be a correction of some sort going into the next few months, or at least that there is going to be a pretty big slowdown in the global economy. And maybe the US might still remain relatively strong and hold out, but I don't think it's going to really go up much higher, especially if the Fed doesn't respond promptly. But let's go ahead and see this other perspective. I think it's important. Trade war, yes. Global slowdown, yes. Volatile market, yes. But does that mean investors should cash out and run? Not this top performing fund manager. She's staying put. Joanne Kwok, who co-manages the JP Morgan Asia Growth Fund, says volatility will linger in Asia markets due to trade war uncertainty and corporate earning concerns. Even though the unpredictability of U.S. President Donald Trump and other political risks, investors should hang on as valuations suggest decent returns in the next 12 months, she said. You just need to be continuously disciplined, said Kwok, whose fund tracking the MSCI Asia excluding Japan index has returned 11% year to date. Excluding Japan, which has been buying up all of its ETFs. Interesting. I'm just kidding. But at this valuation, we should be buying, not selling. Kwok open-end fund has beaten 98% of peers so far this year, and for the past 5 years, based on data compiled by Bloomberg. After wiping out as much as $1.7 trillion of their value in the recent sell-off, Asia stocks have barely recovered losses triggered by Trump's threat to impose a 10% tariff on war on Chinese imports and concerns of a recession, reignited by an inversion in yield curves. While fund managers and strategists agree the volatility will remain, few have chosen the conviction to buy even those stocks trading at attractive prices. Kwok, however, remains almost fully invested with a net cash level of about 2%. As a long-term investor, she prefers regional growth stocks that are more domestically focused in financial technology and consumption-related businesses. So it seems like she's got a focus here in Asian markets, which, quite frankly, she's got a good hit rate of 98%, but I really don't know if this is where I'd be putting my focus at the moment. Again, I guess you've got a really good play here in the sense you could possibly, the way that I would see playing this as an investor, and I know most people don't really play with options, I would buy like a few calls in this case, and puts as well, and you could still, what's nice about options is you can actually mitigate your risk. More likely though, I would buy calls or get more exposure to calls. Basically, if I wanted to make this bet that the trade war was going to get resolved, and then you buy it on Asia stocks in this case that you think have been affected by the fact that, oh my God, there's going to be a 10% tariff on the exports of my goods, right? So that's the thing to focus on here, is that you would basically find ways to place bets in this case. I wouldn't be buying into the stock market in any Asia index, quite frankly, right now, because you've got a lot of problems brewing in Japan. I think that you're having a general slowdown in Asia across the board that's going to get a lot of investors upset. Take a look at the Shanghai Composite. Take a look at the Hong Kong, the Hang Seng Index. Looks kind of messy to me personally, but she's got a pretty good hit rate. I can tell you guys, I don't have a 98% hit rate, but then again, she's probably going for different trades than what I'm going for in that case. And I can say that I've probably outperformed whatever 98% hits that she's got. And that's not me bragging, but I've taken much more risk in that case, right? And again, I think that you can play it really safe and nail it. If for example, over the last few years, you've just been buying stocks and it's been a part of this 10-year expansion, well, then she's going to obviously have a very high hit rate in that case. So that's why, for example, as much as it looks good on paper to have a 98% rate here, we'd have to understand a little bit more about what her position is in this case, but what she's doing outside of just simply, managing a growth fund in this case. So again, anyways, I've rambled on enough, guys. I hope you all are doing well today. I want to know what you all think about the articles that we went through today. What do you all think is making you bullish or bearish at the moment? And really try to get towards the fundamental factors. Share anything that you guys think is really exciting. Maybe people haven't really been talking about. I know we haven't gotten to cover everything here on the channel. Trade war is obviously the focus at the moment, but there's a lot of things brewing beneath the surface right now. We've talked about the shadow banking in India and China. We've talked about the issues with monetary policy and how pretty much every country is becoming Japan at the moment. There's a lot of things going on in the sense of the macro environment. But until the next video, everyone, I'll stop for today. Thank you all so much for watching, and I'll see you all in the next one. Stay tuned.